Well, hello, good morning, and welcome to our 2023 post-autumn statement, post-match analysis. There's a lot to cover today. There was a lot of really interesting stuff in what the Chancellor said yesterday. So we will get straight on with it. Just to remind you of the usual rules of the game. You should all have a link to Slido. Do put any questions you've got in there. We should have plenty of time for questions. We're trying to keep our presentations reasonably brief, though certainly very full of content. As ever, I will kick off by making some opening remarks, and we will then have four presentations. The first from Carl Emerson, who will be talking about the public finances. Carl will be a familiar face to most of you. We then have two debutantes in terms of post-fiscal statement presentations. B. Boileau will be talking about what's been happening to public service spending, and Sam Ray Chowdhury will be talking about the personal tax and welfare changes, and then a brief cameo appearance from Isaac Delestre, who will talk about, in particular, the changes to corporation tax. So that's what we're going to do. As I say, do add any questions to Slido and vote up questions that you like. Those are the ones that I'll see. So what did we see yesterday? Well, inflation may be coming down, but it was increases in the OBR's forecast for inflation that saved the Chancellor's bacon, rather. That's largely what's driving higher tax revenues over the next few years, despite a downgrade in real growth prospects. And it's doing so by more than enough to offset higher spending on debt interest and welfare benefits. Meanwhile, higher economy-wide inflation, measured by the GDP deflator, and I'll come back to that in a minute, this is really rather important, is because departmental spending plans are not being sufficiently topped up in response, resulting in lower real-term spending on public services both now and in the future. That, in essence, is how we end up with an economy in a few years' time no bigger than the OBR was forecasting in March, but with higher debt interest spending and with new tax cuts, with debt falling by a similarly tiny margin to that previously forecast. Now, there were two substantial tax cuts to national insurance contributions and the making full expensing in corporation tax permanent. Yet the projected tax burden is still set to reach 37.7% of national income by the end of the forecast period, its highest ever level in the UK. Effectively, those tax cuts, the national insurance and corporation tax cuts, have been offset by additional revenue generated by the additional inflation. Or you can put that another way, the tax cuts are paid for by planned cuts in public service spending. And you'll see a very striking slide from B later on showing the almost one-for-one tax cuts in public service spending. The net result is that Mr. Hunt is, by the narrowest of tiny margins, still on course to meet his poorly designed fiscal rule that debt as a fraction of national income should be falling in the last year of the forecast period. In reality, debt is basically just about flat, at around 93% of national income for the whole forecast period. And that's on the basis of a series of, to be polite, questionable, to be less polite, possibly implausible assumptions. It assumes that many aspects of day-to-day public service spending will be cut. A bit on that, more on that in a moment. It assumes a substantial real cut in public investment spending. It assumes that rates of fuel duties will rise year on year with inflation, something that hasn't happened in more than a decade and surely won't happen in April next year. And it assumes the constant rollover of temporary business rate cuts. It assumes that that will stop. It assumes, of course, the economy doesn't suffer any more negative shocks. Like his predecessors, Mr. Hunt has taken a modest improvement in the public finance forecast and spent most of it. He has spent upfront and told us he will meet his targets largely by unspecified fiscal restraint at some point in the future. What he'll do in March, I think there's a risk for him. What he'll do in March if the OBR downgrades its forecasts, we don't know. It appears that a lot of his largesse yesterday was made possible by upgrades in forecasts just over the last 6 weeks or so. Any such downgrading in March would leave him with quite a big headache. More importantly, he or his successor is going to have one heck of a headache when it comes to making the tough decisions implied by this statement in a year or two's time. So what about the big picture? Well, it remains rather as we've known it for a while now. Both tax and spending are at high levels by historic standards. Debt interest spending is set to remain around 2 percentage points of GDP higher than it was just in 2019. That's essentially spending, the additional spending on debt interest is equivalent to the entire defence budget. Just stabilising debt requires us to run a substantial primary surplus, bringing in more revenue than is spent on everything other than debt interest. Now, we've not run primary surpluses since the turn of the century. And given the level of debt and debt interest, we'll need to get used to running these surpluses. And that means government taking more out of us, more away from us, than it gives back on everything other than just paying the interest on its debt. And that's one reason that high tax and spending isn't translating into better public services. There is another reason that we discovered yesterday why what were actually intended to be pretty big increases in public service spending over this Parliament haven't actually translated into the better public services you might expect. Higher than expected inflation has eaten into their purchasing power, and it turns out that economy-wide inflation is running much higher, an astonishing amount higher than the OBR thought just back in March. One level doesn't come as a great surprise. The assumption that it was so much lower than the CPI inflation always looks somewhat fragile. But the consequence is that whereas cumulative growth in the GDP deflator, that's the economy-wide measure of inflation, over the Parliament was forecast to be 13% at the 2021 spending review and 16% in March, it now stands at over 21%. That's a big increase in cost. The Chancellor has only compensated public services this year for about a quarter of that increase in costs. So in real terms, they're about 13 billion down on where they expected to be just in the spring. The real annual increase in public service spending over this Parliament looks like being something like 2%, roughly the long-run average, rather less than the 3% or so planned just back in March and indeed back in 2021. Over the next few years, total spending is set to fall, but to remain around 3% of national income above its pre-pandemic level, and nearly 2/3 of that increase resulting from those higher debt interest payments. The rest more than explained by higher spending on health and benefits and state pensions. Now, what's the Chancellor doing here then? He's penciled in numbers that suggest he really wants to try and wrestle the size of the state back down towards where it was in 2019. But given the demands of servicing our debt and presumably paying for more healthcare and pensions, achieving that will require sharp cuts in many areas of public spending. It would also result in a continued change in the shape of the state. We reckon that that would imply day-to-day spending by the Department of Health and Social Care reaching 45% of total resource DEL, up from 40% pre-pandemic and 25% at the turn of the century. So if the Chancellor achieves what he wants to achieve, then health spending is going to continue to rise, to take a higher and higher fraction of everything government does. This is all one measure of the pain that will be inflicted on many other public services under these plans. Remember, George Osborne did manage to get the size of the state back down after the financial crisis. That was really painful. Doing it again will be more painful. Mr. Osborne made his cuts after a decade of big spending increases. Mr. Hunt, or a successor, if we take these numbers seriously, will have no such luxury. So what about the personal tax and welfare changes? It bears repeating that the 10 billion or so cut in national insurance rates pales into relative insignificance alongside the long-term increase in personal taxes created by the 6-year freeze in allowances and thresholds. Higher than expected inflation has added something like 14 billion to the size of that fiscal drag just since March. And you can see immediately that 14 billion is bigger than 10 billion. It also means that the total scale of that tax rise from the frozen allowances and thresholds comes up to some 50 billion over the 6-year period. As a result, the level of personal taxation in 2027-28 will be much the same as was expected after the March budget. The national insurance cut is essentially, though not quite, offsetting the greater than expected fiscal drag. Now, if you're going to cut the rate of either income tax or national insurance, cutting the national insurance rate was a good decision. And a really unusual one. I think it may be the first cut ever. Over the past 40 years, national insurance rates have tended to rise as the basic rate of income tax has been cut. This is the first cut to the main NI rate in modern history, as far as we can tell. Until now, this was a tax that only seemed to go one way. Now, cutting the national insurance rate reduces the wedge between tax rates on earnings and other incomes, and reduces the difference between how we tax pensioners and people of working age. One of the consequences, which I think has not been much remarked upon, is that this, plus increasing the national insurance threshold back in 22, and the fact that the income tax personal allowance for pensioners was aligned with that for those of working age back in the 2010s, means the average tax rate on pensioners and on workers have converged really quite a lot. So what do I mean? A pensioner on £25,000 income pays about £400 more in income tax than they would have done in 2010, while a worker on the same income actually is still paying £1,200 less in combined income tax and national insurance. In 2010, that employee would have paid about £2,750 more than the pensioner. They now only pay about £1,250 more. That is a big levelling up in the taxes between pensioners and those of working age. And that strikes me as unequivocally a good thing. Another striking consequence of all of this is that back in 2010, around half of pensioners paid income tax. Now more than 2/3 do. So a big change in the way that we tax. The same is certainly not true, of course, of what's happening in the benefit system. It was very striking hearing Mr. Hunt yesterday announcing in the same sentence the percentages by which pensioner benefits and working age benefits will arise next April, by 8.5% for pensioners and 6.7% for everyone else. This is, of course, part of a much longer trend of diverging generosity. Minimum benefit entitlements for pensioners are now about nearly 2.5 times higher than for people who are just under state pension age. That's a much bigger difference than where we were 20 or 25 years ago. Now, beyond that, confirming that pensions and benefits would rise in line with a triple lock on the one hand and inflation on the other, after the now seemingly annual game of hinting that they might not, there were two genuine big benefit changes announced. Now, the rebasing of local housing allowance so that it covers rents up to those at the 30th percentile in the local area was welcome. Our work earlier this year, cited by the Chancellor in his speech, showed that freezing at 2019 levels had left 95% of available properties at rents above what the local housing allowance would cover. And don't forget this, some 4 in 10 private renters receive some help with their rent through the benefit system. 4 in 10 private renters get help through the benefit system. It made no sense to freeze support at whatever happened to be local rent levels 4 years ago. The shift to 2023 levels, while welcome, is also predicated on freezing support again indefinitely at that level. We've seen twice now, actually, that that's not sustainable. Having picked a level, it should be indexed. And then there are reforms to tighten the eligibility criteria for higher rates of incapacity-related universal credit. That reflects concerns that increasing numbers of people are being assessed as not able to engage in work-related activity. Numbers in this category have near enough doubled from just over 1 million in 2014 to 2.4 million today. So you can see why there's some action here. People in those categories are excused the need to look for or prepare for work and typically receive an additional £390 a month in benefit. In the longer run, further reforms will end the split between assessments for those incapacity benefits and for disability benefits, personal independence payment, and stop linking work payment to work status at all. Those are big and radical reforms, and Sam will say a little bit more about that. And he'll also show you that experience suggests that controlling spending here will be challenging. The personal independence payment caseload has increased really dramatically in recent years, the numbers flowing on doubling since pre-pandemic. That's remarkable. Finally, on business taxes, Mr. Hunt has described making permanent expensing for plant and machinery in corporation tax as the biggest business tax cut in history. That, to put it kindly, is an overblown claim. It is expensive in the short to medium run, but the OBI yesterday confirmed our view that this is no more than a £3 billion a year tax cut in the longer run. That's a really important point. This is not the scale of tax cut that it first appears. This April's increase in the rate of corporation tax, remember, was an 18 billion a year tax rise. So net, I make 18 minus 3, still a 15 billion tax increase. That's not to say it's not broadly welcome. Certainly making it a permanent feature of the system makes a whole lot more sense than having it there temporarily. But, and there's not been much comment on this, it really is far from a perfect reform. It applies only to investment in plant and machinery, thereby favouring some sorts of investment over others, and it provides a big tax subsidy for debt-financed investment. Really is quite important that these issues are ironed out in the more thoroughgoing reform of corporation tax. We also saw another year of business rates relief for smaller businesses in the retail, hospitality and leisure sectors at a cost of over £2.5 billion. I'm afraid this is becoming one of those temporary reliefs that gets rolled over every year. And that's not a good way of making policy. No one knows what's going to be their rates bill the following year. For the retail sector, a version of it has been in place since 2019, but for hospitality and leisure, it was introduced as an emergency measure to help business through COVID. Well, COVID is essentially over. Lockdowns are over, but this temporary relief keeps getting rolled forward. That's not a good way to make policy. So to conclude, the fiscal forecasts have not in any real sense got better since last March. Debt is not declining over time. Taxes are still heading to record levels. Spending is also due to stay high by historic standards because of high debt interest payments. But those payments plus pressures on health and pension spending mean current plans are for some pretty serious cuts across other areas of public spending. How did Mr. Hunt afford his tax cuts when real economic forecasts got no better? He banked additional revenue from higher inflation and penciled in harsher cuts to public spending. I'm not sure I'd want to be the Chancellor inheriting this situation in a year's time. So on that cheery note, I'm going to hand over to Carl, who is going to talk about the public finances.
Thank you very much, Paul. Yes, I'm going to talk through what changed in the public finances between the March OBR forecast and the ones that were handed to Mr. Hunt yesterday, and how he responded to that and where it leaves us in terms of the outlook for tax spend, borrowing and debt. And there was some bad news in yesterday's announcements. The first bit of bad news that we heard about was that debt interest spending is yet again going to be higher than what we previously expected. So the chart here shows public spending on debt interest as is forecast going forwards. And you can see it's settling down at about getting on for 2% of GDP above what we've been used to. That's a huge increase. 2% of GDP is what we spend on the entirety of the defence budget. And you can see that in 26-27, the forecast produced yesterday said we'd be spending £109 billion. Roll back to March, the forecast for that same year said £93 billion. That's a £16 billion worsening just between those two forecasts. And if you go all the way back to March 2022, you can see that the forecast suggested that we'd be spending just £48 billion in that year. So substantial upwards revision yet again to what we'll be expected to spend on debt interest. There was another bit of bad news in the announcements yesterday, and that is that the outlook for real growth going forwards is now worse than what the OBR previously thought. So the green line here shows you the path of real GDP, so the real size of the economy. And you can see that over the next year, the economy is forecast to grow over the next calendar year by 0.7%. We can compare that to what was thought in March. And the situation is a bit more complicated because we've seen big backwards revisions to GDP. So the ONS has recalculated the numbers and now thinks that GDP has been bigger in recent quarters than what it previously thought. So in some sense, that's good news, and that we are now richer than what we previously thought we are. But what matters for the public finances is not the size of the economy now, because we have a deficit at the moment, and we know what tax receipts are at the moment, we know what spending is. What matters for the outlook for the public finances is how the economy is going to grow going forwards. And the slope of that green line going forwards, the latest forecast, is shallower than the slope on that yellow line. You can see here that in the next calendar year, for example, the March budget was forecasting growth of 1.8%. That's been downgraded just 0.7%. But the Chancellor should be thankful that the OBR is not as pessimistic as the Bank of England. And we must all hope that it's the OBR that turns out to be closer to what happens than the Bank of England. The Bank of England is much more pessimistic. In the coming calendar year, they're forecasting growth of just 0.1%. If that materialised, it would cause even more of a fiscal headache for the public finances. So increase in the forecast of spending on debt interest and a downgrade to the real outlook for the size of the economy. But actually, when you're forecasting the public finances, it's actually the cash size of the economy that matters more. That's because if you're trying to forecast receipts of income tax, national insurance contributions, corporation tax, VAT, what matters is what you think cash incomes, cash spending, cash profits are going to be. And there was a big upwards forecast to the outlook for inflation, which means that the cash size of the economy is both bigger than was expected back in March, but importantly is forecast to grow at a pretty similar rate over the next few years. So while the real growth outlook was downgraded, the cash growth outlook was not. So that helped bolster government revenues. That higher inflation and the fact that the growth we're now getting, the OBR thinks is more tax rich, is more than enough to offset the fact that the real size of the economy, the thing we actually really care about, is expected to be lower. And to give you one illustrative number on that, that freeze that's going on for 6 years to income tax thresholds, and they freeze to many many national insurance thresholds, is now forecast by the OBR to be bringing in £51 billion in 27-28. That's £14 billion more than what the OBR was forecasting the same package of measures, the same package of freezes would raise when they produced their last forecast back in March. So you get extra revenue if your cash economy turns out to be bigger. You particularly get extra revenue when you're freezing pretty much every threshold in the personal tax system. So that gave a windfall gain to the public finances. Now, it's a windfall gain because you're getting more in terms of cash revenues. Yes, the Chancellor had to spend more on debt interest. Yes, he, by default at least, had to spend more on the state pension, more on working age benefits. But there was more than enough left over. And essentially, it comes from a decision not to compensate public services for that higher inflation. So the departmental budgets were left largely untouched. They just have to deal with the consequences of higher inflation within those fixed cash budgets. So that meant there was a windfall gain in borrowing. And we can show how big that is in this chart. So the yellow line here is the March forecast for borrowing, showing a deficit falling from 6% of GDP last year down to below 2% of GDP in 5 years' time. If Mr. Hunt yesterday had stood up, said, I'm not going to announce any measures, and then sat down again, the dotted line here shows you what the OBR's forecast would have looked like. So a lower deficit last year, a lower deficit this year, and that's forecast to persist into the medium term. But that's not what the Chancellor did. He used that fiscal windfall to finance a package of fiscal loosening. And that means the path for borrowing over the medium term is pretty much unchanged from what it was in March. And I think it's important to remember that if we compare not the last March forecast, but the March before to March 2022, when Rishi Sunak was Chancellor, we can see that we're planning to borrow considerably more in each year of the forecast horizon. And this comes back to something we highlighted in a chapter in the Green Budget, which is a tendency of many chancellors since 2010, when handed a worse situation by the OBR, there's been a tendency to say, well, things are worse, it's okay, we'll just borrow more money, not to offset that extra borrowing fully with a fiscal tightening. But when they get handed a better set of forecasts from the OBR, when things improve a little bit, there's a tendency of those chancellors to indulge in a bit more fiscal loosening, not to bank all of the windfall gain. And if we look at the last 3 years of the forecast horizon, we can see that Jeremy Hunt has actually chosen to offset 93%, we think, of the windfall he was handed with a fiscal loosening. But if we go back 12 months, what did Jeremy Hunt do when the OBR told him the forecasts were worse than what had been forecast in their previous EFO? He chose to offset just 18% of that deterioration over the last 3 years of the forecast horizon. So we can see Jeremy Hunt engaging in, actually to an even greater extent, the kind of asymmetric behaviour that we warned about that we see over several Conservative chancellors since 2010. Let borrowing rise when things get worse, but you do giveaways when things get a bit better. If you keep doing that, you'll end up with more borrowing and more debt than what you originally planned for. So where does that leave public sector net debt? Well, if we go back to the March forecast, it was for debt to rise to almost 95% of national income and then basically stabilise. The Chancellor has a fiscal target that says it has to fall between the last 2 years of that forecast horizon. It was just about being met. Debt was falling by £6.5 billion. People describing that as headroom. It's next to nothing in the context of how uncertain and how volatile this measure is. Had Mr. Hunt yesterday stood up, not announced any measures, we think that debt would have been following this kind of path. It would have been at a lower level because of the upwards revision to GDP and the higher inflation. And it would be forecast to fall in the last year of the forecast horizon by a bit more, would have given him quote unquote headroom of £31 billion. But because of his giveaways, because of the big fiscal loosening he engaged in, debt is pretty much stable throughout the medium term here. Yes, there's a decline in the last year. It's pretty small, £13 billion. It's been described as a doubling, but it's still next to nothing given the uncertainty and volatility of these forecasts. And again, you can see that debt is forecast to be much higher and on much less of a decisively downwards path than what was forecast in March 2022. Essentially, the forecasts now are for debt to continue rising for a couple of years and then stabilise. So how much headroom have we really got? Well, if Mr. Hunt hadn't done anything, he would have had £31 billion worth of headroom. We know that from the OBR document we got yesterday. We also know that in recent weeks, the OBR have been handing the Chancellor different forecasts as they update their methodology, as they look at how the economy is evolving. And if we look in the Sunday Times from a few weeks ago, it looks like when the first set of forecasts were presented from the OBR to the Chancellor, the headroom was actually put at minus £19 billion. Now, we don't know if that's correct. We haven't seen that forecast from the OBR. But if it's true, it suggests that the forecasts have moved to improve the outlook on that fiscal measure by £50 billion in just 44 days. So that's a pretty big improvement. I think what it also shows you is how volatile that is. I think it also shows you that if you hand the Chancellor a windfall and he's then choosing to give a fiscal loosening that basically gives away all of that extra quote unquote headroom, it suggests a world where we have policy decisions which are being ridiculously fine-tuned into responses to what is a very, very uncertain and volatile set of forecasts. Not a good way to make policy. And I think, what gets better could also get worse. The next budget looks like it might be around 125 days away. If I was Mr. Hunt, I'd be worrying, well, that's a lot more than 44 days. So the amount of uncertainty, the degree to which my forecast could move might be even bigger. Of course, he might get lucky. Maybe we'll get to afford even more national insurance cuts come the spring budget, but he might get unlucky. And the suspicion has to be that if he gets unlucky, he perhaps won't choose to do tax rises in the forthcoming budget. So how over a 125-day period might you lose £13 billion? Well, there's a set of assumptions in the policy, in the forecast the OBR has to make around what policy settings will be. And there's a load of admissions or policy changes we could make that would easily spend that sum of cash. So, for example, we could say that we're going to continue to freeze field duties at their current level, which is what we've done pretty much since 2010. If we did that, it would use up £6 billion of that headroom at a stroke, so almost halving the headroom. Paul mentioned the business rate relief that we seem to keep wanting to extend for another year. We could say, well, we're going to make that permanent. That would be a £2.5 billion tax cut. As you'll see in B's presentation, the plans we currently have penciled in for spending on public services in the next Parliament suggest to us that unprotected departments face cuts of about £20 billion. We could decide we want to avoid those. If we did all of that, we'd quite clearly be in a world where debt would no longer be forecast to fall. And I think what that really raises is the credibility, or it raises questions about the credibility of the stated policy settings. Do we think it's realistic that we're going to start allowing field duty rates to rise in cash terms? Do we think it's likely that we're going to allow this business rate relief that we originally put in place in part because of the pandemic? Are we really going to stop extending that? And yes, we've cut public spending before, but doing cuts again would be harder this time. And we haven't specified any of the areas where the axe would yet fall. Let's step back a bit and look what's happening to the size of the state. And in fact, this red line in on this chart here is probably the most important line in the entirety of my presentation. It shows public spending as a share of GDP over time. You can see the financial crisis pushed it up. You can see the decade of austerity with the spending plan set out by George Osborne basically meant over a 10-year period, the size of the state was returned back to its 2007-8 level, where it had been put after 10 years of new Labour governments. We then see that huge spike up from the pandemic, pushing public spending in the UK to record levels. And we see another little spike in 2022-23 as the government supports households and businesses with the cost of living crisis. I think what's really interesting about the forecast is, yes, there's a decline in public spending as a share of GDP going forwards. So the spending plans might look tight in terms of the increases that are available, but spending still remains at a pretty elevated level. In 28-29, the government is planning for the size of the state to be considerably bigger than what it was in 2019-20. So why is that? Well, a big part of the story, unfortunately, is not because we're spending on the kind of things we want to have, it's because of spending on debt interest. So if we strip that out, we can see that spending outside of debt interest, it gets closer to the 2019 level, but it's still elevated. So it still looks like we're on course to have a bigger state at the end of the forecast horizon on this measure of public spending than what we had prior to the pandemic. And it seems to us that's likely to be driven by increases in spending on healthcare and increases in spending on social security benefits, including state pension payments. So what's happening on the tax side? Well, the green line here shows you what's happening to government revenues. You can see that they've increased pretty sharply since 2019-20, and they're forecast to continue rising as a share of GDP. And as Paul says, at the end of the forecast horizon, are forecast to exceed non-debt interest spending. We're forecast to have quite a considerable primary surplus. That'll be the first time we will have had one since the start of this century. And actually, given the size of debt, given the interest rates on that debt, and given the weak outlook for growth, we need to be running primary surpluses of that kind of size if we want to have debt stabilized in the medium term. So a big increase in government revenues as a share of GDP. An obvious question to ask is, to what extent are they coming from taxes? And the answer is that they're very much being driven by increases in tax over the current parliament. This chart is showing you tax revenues as a share of national income, how that's evolving over time. And you can see that taxes are being pushed up as a share of GDP pretty substantially over the current parliament to levels that are record levels by UK standards. So they're not rising to quite the high level that they were forecast in March because of the tax cuts that Mr. Hunt set out yesterday, but they're still on course to rise to record levels. And indeed, if we look at the increase in tax revenues as a share of national income over every parliament since 1950, it's still the case that the current parliament remains on course to be the biggest tax-raising parliament in modern history. So to conclude, the public finances have been hit by a downgrade to the outlook for real growth over the next few years, and an increase yet again in how much is expected to be spent on debt interest as the cost of financing the government's debt continues to rise. This was more than offset by higher inflation, which boosted revenues, while Mr. Hunt was content to allow largely departmental allocations to shrink in real terms. So he chose not largely to top up government departments to help them deal with rising costs. That gave the Chancellor a windfall, which he used to finance tax cuts, although it's important to remember that taxes are still on course to reach a UK high and have still risen very sharply since 2019. And despite all of that, debt remains barely on course to fall in 5 years' time. And even that forecast is based on questionable assumptions around policy settings in certain areas. That's all from me. I'll now hand over to Bea, who'll talk you through those public spending plans in more detail.
Thanks very much, Carl. So we've just seen that the public finances have been improved by higher inflation despite the rises in debt interest and lower forecast growth. And this has pushed up tax revenues. The Chancellor used this windfall on tax cuts with very little explicitly announced yesterday on the spending side of things. And I'll now go through what that means for public services. So yesterday, we saw much higher forecasts for the GDP deflator, which captures domestically produced inflation, compared to what was expected in March. So here I'm showing you the OBR's forecast for growth in the GDP deflator in March, and here are the November forecasts. So note that in particular, growth in this measure of inflation is expected to be much higher this year, 2023 to 24, running at 6.1% compared to the 2.5% growth expected in March. And it's also higher for the rest of the periods we consider, meaning much higher cumulative growth in the deflator compared to expectations. This is a relatively obscure sounding measure of inflation, but it matters because we use the GDP deflator as a proxy for the costs that public services face. Higher GDP deflator inflation without any changes in the cash funding that departments have will squeeze departmental budgets in real terms and mean that departments will find it harder to meet funding pressures. So we can think about what this growth in the GDP deflator means for growth in departments' real budgets. And here we'll think about day-to-day spending budgets across this parliament. So the cash increases that were announced for day-to-day budgets over the rest of this parliament were nowhere near enough to offset the impact of higher inflation on the real terms generosity of spending. So here I'm showing the planned average real terms growth in selected day-to-day budgets over this parliament in March. And here I'm showing you what this growth is falling to in November 2023 plans. You can see that this higher inflation has meant that there's significantly less generosity for departments basically across the board. We expect these departments to be squeezed and cost pressures to be growing. After the end of this parliament, we did see some extra cash provided for day-to-day funding, but investment spending wasn't topped up in cash terms. And the falls to day-to-day funding as well as capital spending over this parliament were baked in, and the additional cash offered was nowhere near enough again to offset the impact of higher inflation. And all this means that the real terms generosity of overall public service spending compared to March is much lower in November. So here I'm showing you the reduction in the real terms generosity of public service budgets, just comparing March of this year and November of this year. And this is driven by this higher than expected inflation squeezing departmental budgets. And we can think about how this reduction in the real terms generosity compares to the tax cuts that were doled out by the Chancellor in yesterday's autumn statement. So the cost of these tax cuts totaled around the same amount. So we're thinking about 20 billion in 2027 to 28. And this is an amount that could have been given to public services to compensate for the higher inflation that they're facing and the cost pressures squeezing them. And here we're only comparing the difference between planned growth in March and planned growth in November. And we know that even in March, spending plans set after this parliament, so after 2025, looked very tight. The government did provide some additional cash in plans post-2025 to keep the average annual increase in day-to-day funding after 2025 at around 1% a year annually in real terms. But we shouldn't expect this increase to be even across all departments. We can calculate what it means for most departments if we assume there's some protection that takes place for some selected departments. So if we assume that NHS budgets grow in line with the NHS workforce plan, so by 3.6% in real terms, we keep schools funding flat in real terms, reflecting slightly falling pupil numbers, and we assume that defence and aid spending are held constant as a share of GDP to reflect this government's international commitments. We'll also assume the government holds to its childcare entitlements promised in March. Then the outlook for other unprotected departments looks pretty tight. So we expect this to fall by 1.8% annually in real terms. So this is budgets for local government, further education, courts and prisons, for example. And even this is an underestimate. So we know that when funding for the NHS in England is topped up, this means more funding flows to devolved governments in Scotland, Wales and Northern Ireland. And when we account for this, it looks like cuts to unprotected English departments are of the scale of 3.4% cuts a year in real terms. And we estimate that in the final year covered by this forecast, in 2028 to 29, around £20 billion would be required to avoid making any cuts to these unprotected budgets. And here we're just thinking about plans for day-to-day spending after 2025. But the outlook for investment spending, if anything, looks even tighter. So here I'm showing public sector net investment as a proportion of GDP over time, and here's the outturn. So in March, this was planned to be held fixed in nominal terms after 2025, meaning that it fell as a proportion of GDP as inflation eroded its value. And it got no cash top up yesterday, meaning in November 2023, it looks even tighter and falls by more. And it's worth noting that even with the extra £20 billion that Labour have said they'll invest, investment would be on a falling path as a share of GDP, implying that really significant sums are needed for capital budgets to prevent investment from falling. So overall, this much higher inflation that's now expected to take place really squeezes departmental funding. While there have been some cash top-ups to plan day-to-day spending after 2024 to 25, we've seen that the outlook for plans in November compared to what was planned in March look very tight, and the significant real terms cuts have been made. The tight spending settlements set out after 2025 mean really significant cuts for unprotected departments, and we estimate, as I've said, that this would require around £20 billion in 2028 to 29 to avoid any cuts to unprotected departments. There's no extra cash that's been announced for capital spending, and this is lower each year in real terms. Even Labour's extra funding is not enough to avoid investment falling as a share of GDP. And it's worth noting that the government hopes that these tight plans for spending might be achievable if there's large boosts to public sector productivity. But this will only help if public services can reduce inputs, allowing them to spend less rather than just boosting public sector output. And it's also worth noting that the big capital spending cuts currently penciled in are unlikely to help with productivity boosting ambitions. Okay, I'll now pass over to Sam.
So, thanks, B. I'm going to discuss some of the measures announced yesterday relating to personal taxes and benefits. So, really, the headline announcements yesterday were these cuts to national insurance. And so what this entailed was for employees, a 2 percentage point cut in the main rate from 12% to 10% on earnings up to around £50,000. There are also cuts for the self-employed, a 1 percentage point cut from 9% to 8%. And the Chancellor also abolished the flat rate Class 2 national insurance contributions, the latter of which is really a welcome simplification for the self-employed. Now, taken together, these changes will benefit nearly 30 million workers, and it's a really quite significant tax cut, costing around £10 billion a year. However, what should be noted is that this really is still a small giveaway in the context of the threshold freezes that have been ongoing since 2021. So what the government's done is it's kept the thresholds at which income tax and national insurance are paid frozen in cash terms since that point, and that's dragged more, and that's effectively increased taxes when inflation's been so high. And what the national insurance changes amount to really is giving back less than £1 of every £4 that those tax increases from freezes is taking away. So really, this is just a small offsetting. This is also a change in direction of policy by targeting national insurance rather than income tax. So historically, what we've seen is over time that the basic rate of income tax has tended to fall. And on the other hand, the basic rate of employee NICs has tended to rise. And so this 2 percentage point cut that was announced yesterday really does stand out. Now, there are some key differences between employee NICs and income tax. While employee NICs is only relevant for earned income, income tax applies to other forms of income such as pensions and savings. And this means that a cut in the employee NICs rate is actually a better targeted way of improving work incentives. It also has implications for who these sort of changes apply to, specifically because employee NICs relates to earned income. Then for pensioners, they're going to be unaffected by such changes, whereas pension income is liable for income tax, and so changes in income tax do affect them. So, as I said, since pensioners don't pay national insurance, then they don't gain from these cuts that were announced yesterday. And this is similar to another change that happened during the 2010s, which was where the personal allowance for pensioners for working age people was aligned with that of pensioners and increased. And this meant that the increases in this allowance were smaller for pensioners than for working age people, since pensioners' personal allowance started off higher. And this has contributed partly to this increase in the number of pensioners paying tax. So while it was just half of over 65s in 2010, now that figure is more than 2/3 who are paying tax. So what have been the combined effects of these changes? Well, for an individual who has £25,000 of income pre-tax, well, under the system as it was in 2010 to 11, a working age employee would have paid a significant amount more than a pensioner in income tax and national insurance. And that's still the case in 2024 to 2025. However, the gap has shrunk quite significantly. And it should be said that this is quite at odds with the direction that other policy has taken. And so wider policy has tended to see pensioners benefiting more than working age people. And one example of that is benefits policy. So think about the basic benefit entitlement for a pensioner compared to a working age person with no other income. Well, in 2010 to 2011, the pensioner received about twice as much, so much more. However, by 2024 to 2025, that's growing even further, with around 2.4 times higher amount for a pensioner. So in terms of benefits, then the gap between them is actually getting bigger, whereas these tax changes are shrinking it. So there's some contrast there. So that's more of a historic take, but looking forward, what were the effects of these NICS changes and how do they relate to the threshold freezes? Well, this chart shows the change in income tax and national insurance contributions in 2027 to 2028, which is the year at which these freezes are currently scheduled to end. And what you can see is, thinking about the situation back in March, well, what it looked like was that these freezes were going to increase taxes by just over £500 for a basic rate taxpayer. However, since then, upward revisions to inflation mean that this figure is actually now going to be more like £900 a year increase. So if the Chancellor hadn't done anything today, then as you can see, these taxes, just due to the change in inflation forecasts, are now much higher. And so, as we've seen, the Chancellor hasn't decided just to do nothing, he's decided to spend it. But rather than spend it on increasing the thresholds for either income tax or national insurance, and what that would do is shift down the November line here closer to the March line, he's decided to do something slightly different and change the rate of national insurance. And as you can see, the effect of this is quite different in terms of distributionally. So rather than reducing taxes for the same amount by everyone, really, and you can see that actually the gains here on the rate cuts are larger for people on higher incomes. So that's what's happened on the taxes side, but now moving on to think about benefits. Well, the first key announcement regarding benefits was about support for private renters. And just a bit of context here, this is a really significant policy, the way that private renters are supported with their housing costs. So around 40% of private renters currently receive support through the benefit system with their housing costs. However, since April 2020, LHA rates, which are effectively the caps on the amount of support that people can receive, have been frozen in cash terms. Now, at a time of rapidly rising rents, as has been the case in the past few years, this has created huge affordability pressures for recipients. And it should be said that the extent to which these pressures arise does vary across areas, because people living in an area where rents have grown very quickly will be under particular pressure. Now, we can see what the effects of kind of freezing and decoupling LHA rates from local rent prices are on this chart, which shows the share of private rental properties on Zoopla, which can be covered by housing benefit. And so the first time that this happened back in 2018, we can see that the effect was to effectively a steady decline in the share of rental properties which can be covered by housing benefit, reflecting the fact that while rents were rising, then the LHA rates weren't rising to keep up with that. However, in April 2020, the government rebased LHA rates, setting them at 30th percentile of local rents. So reforming that link between local rents and LHA rates. And you can see that actually overnight what that did is jump up the share of affordable properties back to where it was roughly in 2013. However, since then, there's been there's been very high rises in rents, and that's led to this precipitous decline in affordable properties, so much faster than we saw in the 2010s, such that by the start of 2023, just 5% of rental properties on Zupa could actually be covered by a housing benefit. And so either this would really limit the options for housing benefit recipients, or it would mean that they would have to cover more of their rent themselves. Now, in response to this, the government has said that next year it's going to effectively do what it did in April 2020 once again. So it's going to increase rents back to the latest 30th percentile of local rent levels, but then after that it's penciled in another freeze, so it's going to keep the LHA rates at their same amount. And so what this means is that really we're just repeating the same problem again. So we might expect, going back to this chart, to see a similar jump up increase at the time of the rebasing, but rents are still rising very quickly, around 10% a year. And so what we'd expect to see is this very sharp decline again, and in a couple of years' time, without any changes, we're likely to be facing similar problems as we are now. Now we can look at what the effects of these NICS changes, the LHA changes, and in fact all tax and benefit changes since April 2019, and how these effects have differed across the income distribution. So firstly, these blue bars show the change in income for different income groups since April 2019, and this was before any of yesterday's announcements. And what we can see is that generally there were declines in income, although these tended to be larger for people on higher incomes. Now, and back to the announcements yesterday, so the cut to NICS and the increase in LHA rates, and really most of this effect is down to the national insurance changes. What we can see is this has actually increased incomes because of these cuts in taxes. But what I'd emphasize is that overall, we really see that the total effect has not changed. There's a slight offsetting, but really the overall pattern of significant declines in incomes for most income groups still persists. And this is true measured either in cash terms or as a percentage of total income. The other area where the government has set out some quite substantial reforms is for incapacity benefits. So incapacity benefits are benefits for people who have a health condition that limits their ability to work. And when someone applies for incapacity benefits, they'll be assessed and they'll be categorized either as having a less severe condition or a more severe condition. So someone with a less severe condition, they are not required to carry out work-related activity they have to carry out, they don't have to search work, they have to do some work-related activity, but it effectively means the conditions they have to satisfy are reduced to continue receiving their benefits. However, some people are assessed as being in the more severe category. Now, for these people, they have kind of lighter conditions for receiving benefits, but also they receive additional benefit income, typically around £400 a month. And as we can see, that while for the less severe category, then the number of claimants has been pretty stable over the past few years. Instead, for the more severe category, there's been a very sharp rise, and in fact, it's almost doubled between 2014 and 2022. And the OBR forecast that without any policy change, that rise would continue, such that there would be almost 3 million people in this more severe group by the end of the forecast period. So the government has announced some changes to this. Firstly, for new claimants, they've announced changes to the assessment used to decide whether people should go into the more severe group or the less severe group. So the first thing they've done is they've made a change such that having a severely limited mobility will no longer be a reason that contributes to be assigned in the more severe group. What they've also done is they've changed the criteria around substantial risk, which judged whether people could be put in the more severe group due to having a substantial risk of or mental or physical disability. And so they've raised that threshold, meaning that less people are going to get into the more severe group due to this. So that's what they've done for new claimants. They've effectively tightened the assessment a little bit to make it more hard to end up in this more severe group. Now, they've also made some changes for existing claimants, but these actually go in the opposite direction. Rather than make the assessment more strict, what they've done is they've abolished reassessments completely. So people who have these, people who are already receiving incapacity benefits from April 2025 are not going to have any chance of being reassessed, and so we'll just keep that permanently. And we can look at what the effect of really specifically the changes to the assessment for new claims will have according to the OBR. And by the end of the forecast period, they predict that this will mean 370,000 fewer people in the more severe group, although most of these will move to the less severe group, with that increasing by 342,000. But really, we can caveat all of this by saying that this is only going to have a short-run impact, because of the assessment that the reforms apply to, the work capability assessment, is actually due to be scrapped in the next few years. This is part of wider, more fundamental reforms, which will change the way that eligibility for incapacity benefits works. And in fact, eligibility will be changed to depend on receipt of another benefit, disability benefit or personal independence payment. Now, this is a benefit for which the caseload is also rapidly rising. And yet the government hasn't laid out any changes to assessments for this. And so we can think that really the long-term effects of this will be much more muted than these short-term effects. One other thing that's worth mentioning is that when we think about trying to reform health-related benefits in order to deliver savings, it's often much more tricky than we might imagine. So this chart shows just spending on disability benefits. And first, we can see that leading up to 2013, there was a general rise in spending, but what was predicted before the implementation of personal independence payment was that there would be this would lead to a decline in spending. So this new system would help reduce the burden, the spending burden, that is. However, what actually happened is we saw a significant increase in spending. And so this really highlights that while reforms might aim to deliver things, then when it comes to assessments and deciding whether these vulnerable people should continue to receive benefit income, it becomes a lot more complicated. And often reforms don't turn out like you might project. So just to summarize, these headline, very visible cuts to the rate of national insurance contributions will mean lower taxes for almost 30 million people. But it's still a long way off on doing the less visible increases from freezing national insurance and income tax thresholds. Rebasing LHA rates to the 30th percentile of local rents will alleviate the pressures on low-income private renters, at least for next year. However, it's disappointing to see a repeat of past mistakes. So they haven't chosen to index future LHA rates to either inflation or local rents in future years. And so this freeze is likely to mean that in a few years, we're in exactly the same place as we are today. Changes to the assessment for incapacity benefit are likely to reduce the caseload to some extent, which will deliver some short-run savings. However, really the long-term effects are likely to be much smaller, given that future reforms mean that it's actually the PIP side of health-related benefits which are going to be more important, and there hasn't been any change announced to this. So this means that actually these changes outlined are really more for the short run. Thanks, that's all from me. So now I'll hand over to Isaac to talk about expensing.
Yeah, thank you very much, Sam. So as Paul said, I'm going to give you a very quick whirlwind tour now of full expensing and corporation tax. This is a policy that was first announced in the March budget. It was going to be temporary at that point. It's now been made permanent as of yesterday. Now, the obvious question here is, what actually is full expensing? So full expensing essentially means that when a company makes an investment, say it buys a new machine, under full expensing, it's going to be allowed to deduct the entire cost of that investment from its taxable profits for the purposes of corporation tax, and it's going to be able to do that upfront from day one. So how that compares to the previous system is that companies were previously allowed to do this kind of upfront deduction for up to £1 million of investment a year, but any investment in excess of that, they'd only be able to deduct gradually over a number of years. So this is bringing the timing of when they can make those deductions forward. Now, important to say that this is a change that isn't applying to all assets. It's only applying to certain kinds of plant and machinery, and also it's not applying to all kinds of businesses, only applying to incorporated businesses. Now, we heard the Chancellor 3 times yesterday in the autumn statement say this is going to be the biggest business tax cut in modern British history. That isn't really true in any meaningful sense. So the OBR costed this policy at about £11 billion in 2028-29. That isn't wrong, but it's only part of the picture. And that's because, as I've just said, full expensing is essentially a policy that allows businesses to take deductions upfront and immediately, but to do that instead of taking those deductions in the future. What that means for the Treasury is that this policy is going to have a big upfront cost, but actually the Treasury is going to end up getting a lot of that money back in the coming years, because those delayed deductions aren't going to be made. And that's purely a timing effect. It's nothing to do with the amount of growth or investment we think this policy is going to lead to. And so in the long run, we think the cost is going to be a lot lower, in the low billions. The OBR thinks about 3 billion. And just to put that in context, let's recall that when the Chancellor increased the main rate of corporation tax from 19% to 25%, that was a tax rise for business of about £18 billion a year. So this is much, much smaller than that in magnitude. Okay, so maybe this is not as big a tax reduction as the Chancellor made out. What are the effects of it going to be on investment incentives? So in order to illustrate that, I'm just going to show you a couple of example investments here, one in plant and machinery that qualifies for full expensing, one for another example asset in buildings in this case, which doesn't qualify. And I'm going to be showing you the effective tax rate on those different investments. And crucially, these are going to be just break-even investments. So that means whenever you see a positive effective tax rate on this chart, that means investment is being disincentivized. There are investments that aren't happening because of the tax system. And what we'd ideally like to see in a really well-designed tax system here are zeros across the board. That would mean no investment being disincentivized. Now, under the old system, we can see that both our example investments are seeing this positive effective tax rate, that we are seeing a disincentive to invest. As a result of yesterday's change, qualifying investments are going to get this 0% effective rate. That's a good thing. That means that we're not disincentivizing those break-even investments. That's definitely desirable. Worth noting, though, that the investments that aren't covered are really being left out in the cold here. They're not seeing any reduction to the disincentive to invest. And actually, we're seeing an increase in the bias towards included investments relative to excluded investments. Now, these were both examples of investments funded by equity. That means essentially funded by a company's own money. One important feature of the UK tax system is that where investment is funded by debt, the current system actually produces a pretty substantial subsidy for these kinds of investments. And that can actually be a pretty damaging thing, because it means that investments that are low productivity, that are low profitability, are going ahead when they wouldn't actually be viable in the absence of tax. And one really important thing about yesterday's change is that it's really going to increase that debt subsidy for eligible investments. So yesterday's change is going to increase the amount of investment, but whether that's a good thing is really going to rest on whether those investments are the kind of profitable investments we'd like to be encouraging, or whether it's actually going to be an increase in these subsidized, low productivity, low profitability investments. More investment on its own isn't just necessarily a good thing. So there are definitely positive aspects to yesterday's reform, but there are also very significant downsides, and we shouldn't ignore those. Now, just to take a step back for a second, the context for this is that in recent decades, we've tended to see chancellors cutting the rate of corporation tax and widening the corporation tax base. Now we seem to be seeing the government taking a different direction, where they're increasing the corporation tax rate and narrowing the base. Now, that isn't necessarily a bad idea, and on balance, we do think that it's welcome that the Chancellor chose to make this change permanent rather than just allowing it to expire. But we also really only see this as the first step. We'd like to see this policy significantly extended. We'd like to see it apply to all businesses and all asset types, and we'd also like to see the Chancellor tackle once and for all the damaging subsidy to debt finance investment.
Well, thank you ever so much, Carl, B, Sam, and Isaac, for that fantastic run through of what was a very busy and interesting autumn statement. We have got a pile of questions here. I'll try and run through as many as I can. I also have a couple of colleagues on the call who you won't have seen yet, who I'm just going to warn Ben that I'm actually going to call him on the first question here. Ben being having worked with B on the public services cuts. What public service will be affected by these plans, and what will be the real world effects?
Within that pot, which we're calling unprotected, basically those areas not fortunate enough to be covered by existing commitments, covers things like local government, which is responsible for social care. It includes justice, so prisons and courts. We know that we've got full prisons, we've got courts with long backlogs. It includes lots of government departments that employ a lot of civil servants in operational roles. Think HMRC, DWP. Think if you've got a tax query, think if you need to go to a job centre. Those areas are the sorts of things that might be squeezed. And it seems inconceivable that you can make cuts of 2 or 3% a year to those services and not have some impact on quality. So we've seen councils in financial difficulty. Maybe we'll see more of that. We've seen quality of service in prisons and the court system deteriorate. Maybe there'll be more of that. But unless you can find some magnificent, heroic productivity improvements in those areas, I think it seems likely that the range and quality of public services would have to suffer at some point.
Thank you. The next question, for speed, I'm going to try and answer some of these, but my colleagues, please butt in if you've got more to say than I have. From Joel Massey, says Sunak and Hunt said Labour's plan to borrow 28 billion a year will lead to higher debt, inflation, interest rates, taxes, cost of living, and general disaster. Is that plausible? I think that's it's one of these curious things. The Chancellor had a £20 billion giveaway on the tax side yesterday. That 28 billion from Labour is actually more like 20 billion in current day terms anyway. But of course, the way that these things often work is that Labour will be held to account for things that are different from the baseline, which is the baseline the Chancellor just put in place yesterday. But he's just taken 20 billion out of that baseline in terms of cutting taxes, whilst penciling in, as we've seen, some additional cuts to spending. So all of that said, finding an extra £20 billion for green-related investment, given the state of the public finances that you've just seen, will be quite challenging. Not necessarily because £20 billion is a vast sum in its own right over a 5-year period, but more because of the scale of competing demands for spending over that period. So clearly it is overblown to claim that it will lead to all of the disastrous things that have been claimed there. But clearly it will also be a difficult thing to achieve. If it was the only thing that Labour wanted to achieve, yes, of course you could do it. But given the scale of challenges elsewhere, it's not going to be straightforward. Unless anyone of my colleagues wants to come in on that, I will move on to a question from Hugo. Guy, can you explain why debt interest costs are now so high? Is it mostly a product of high interest rates? And if so, does that give the bank MPC decision outside influence on public finances in the future? I think a first approximation, the answer to that is yes. But Carl, do you want to say any more than yes?
Yes, it's down to the fact that both gilt rates, so loosely speaking, that's in large part people who live overseas who are lending money to the UK government, who have other governments they could lend money to if they prefer to, but they're demanding a higher price than a few years ago. And also bank rate, which now directly affects the government's debt interest bill because of the way QE works. So we were always going to become more vulnerable to changes in bank rate and changes in gilt rates if we have higher debt. That's the way it works. I don't think it's necessarily inappropriate. I mean, the Bank of England's got to change bank rate with an eye on the inflation target 2 years out. The Chancellor just has to deal with the consequences of that when he's thinking about the management of the public finances. But we have elevated debt, we have higher interest rates, and we have our debt financed in such a way now that it's more quickly adjusting when bank rate changes than what would have been the case in some world where we were back in 2007 and there was no quantitative easing.
Question from Chris Smith. The OBR seems pretty sceptical about the post-2025 planned spending cuts, given precedents. How likely is any chance to stick to them should politicians not take them seriously in an election campaign? I've sort of got two elements to an answer to that. I think certainly over the last significant period, we have seen chancellors topping up these sorts of penciled in numbers by quite a lot. And I think the OBR was talking in the order of £30 billion when it actually comes to spending reviews. And as you've heard from B and from Ben, the challenge of sticking to these will be really very serious. That said, I do want to be a little bit careful in saying that these are not serious figures. I do recall, I showed you how long I've been doing this, the 2015 election, I said pretty much in terms that the Conservative plans to cut 12 billion off welfare wouldn't happen. And they did. They did find 12 billion of cuts off welfare, a little bit less quickly than they said they would, but they did find them. And the Chancellor would certainly say that he's committed to finding reforms and productivity increases in public services. All of that said, I think the chances that we will actually get public service spending cut in the way that you've seen in the figures that be presented are pretty small. And I would take a small bet, at least, that that's not what's going to happen. And that is going to make, I think, a lot of the pre-election debate about the public finances quite difficult to follow because of this strange baseline that we're working to. And I'm afraid we are probably going to bore you and everybody else silly over the next year saying exactly that the public finances look really difficult. If you take these numbers seriously, you are talking about spending cuts. If you're talking about spending cuts, please, Labour and Conservative Party, tell us what you're going to cut. And if you're not, please tell us which taxes you're going to increase. Whether we will get any answers to that, I do not know.
Paul, can I add something on that?
Yes, please.
So I think it's worth distinguishing here between what's penciled in for day-to-day public services and what's penciled in for capital. The cuts to capital are much deeper. There's also much more of a precedent for governments cutting capital spending when times get tough. I don't think we can doubt government's ability to do that. Partly that's because it's easy to sort of cancel infrastructure projects for which the effects don't show up for a while. You can argue that we're currently living through the effects of cancelling lots of those projects in the 2010s. When it comes to day-to-day public services, again, it's not as though the government has never implemented cuts like this before. During the early 2010s, non-health public service spending was cut by around 3% per year, just shy of, between 2010 and 2017 or so. So it can be done. The difference is that came on the back of about a 40% increase in the previous decade. Now, those budgets are about 7% lower than they were in 2010. So it's just doing the same scale of cuts when you've already done some cuts is much, much harder. And that's why I think we need a bit more skepticism.
Absolutely. Can I keep you on then, Ben? The next question is really about the painfulness of the cuts planned here relative to what George Osborne planned, and indeed how that relates to the productive capacity of the economy. I think you've pretty much answered the first of those questions, actually.
Yeah, I think they're broadly comparable in scale. So, as I said, during the early 2010s, non-health budgets were cut by just shy of 3% per year in real terms. B showed you that on a set of what we think are credible assumptions, unprotected budgets could be facing cuts of around 3% or so each year post 2025. So, broadly similar. As I say, the difference is that there's going to be much less fat to trim to begin with, and we can expect some very real impacts, particularly as I think the pandemic has added some pressures to some of those budgets. In terms of the wider impacts on the economy's productive capacity, I think there's some evidence that, for example, NHS waiting lists might have, on the margin, led to some extra people dropping out of the labour force. But the OBR looked at this in quite a lot of detail in July and concluded that it's not a major factor. A lot of this stuff is hard to pin down. Clearly, there will be impacts. I think the biggest impact is on users of these services and the quality of service that they get.
Brilliant. Thank you. Isaac, question from John Paul Ford Rojas, probably pronounced that wrong. Can you explain a bit more what you mean when you say full expensing provides a subsidy to debt-fueled investment?
Yeah, sure. So the reason this results is that when you take out debt as a company, when you pay back interest on that debt, you're able to deduct that from your taxable profits. Um, what that means in the context of full expensing is that you can essentially have a situation where people get that deduction for their investment up front, but then they're also getting a second deduction for any debt interest that they're paying subsequently. And that can essentially lead to the situation where, say, an investment that in the absence of tax would get you a 1% return, as a result of the tax system, ends up getting you a higher return. So maybe 1.5%, 2%, something like that. And the result of that is that an investment that in the absence of tax just wouldn't really be worthwhile, say it's just too low return, it's just bumped up to being worthwhile. So we get these investments potentially that are just too low productivity in the absence of tax to be viable, and they become viable as a result of that subsidy, as a result of the fact that you can deduct debt interest from your taxable profit. So that's really what's going on there.
Brilliant, thank you. Assuming no one else wants to come in on that one, a question from Sue Hunt says yesterday, our choice is not big government, high spending and high tax. Does what you're saying essentially mean that people are going to be forced into that? I think to some extent it does suggest that. I mean, I'm on record. This is quite a bold forecast, really, as saying that taxes over this Parliament have risen by 3 or 4% of national income from where they have been for a very long time. So they've been, they have hovered in the sort of low 30s for decades, and they're moving up to 37 or more percent of national income over this decade. The forecast I've made is that they won't go back down in my lifetime to where they have been over the first 5 decades of my lifetime, and it's exactly for the reasons expressed in the question, not because this is a government, or indeed any government particularly wants a massive state and a massive tax burden, but we are going to be spending more on health. The health workforce plan published earlier this year by itself will cost 2% of national income in the medium term. We are going to spend more on pensions. And after a decade of austerity, it's quite hard to see where we make other cuts. And in addition, of course, we've got this very high level of debt and therefore debt interest spending. So that doesn't mean there aren't choices. You can clearly do as Mr. Hunt is doing and try and do everything you can to push that down. Or you can spend more. But my guess is that we are in a new equilibrium in terms of the scale of tax and spending going forward. I could be wrong about that. I have often been wrong in the past, but I think that is where I would place my money. Carl, it won't surprise you to know that the next one I'm going to turn to you. Are the Chancellor's rules for his fiscal headroom sensible? If you were setting fiscal rules, what would they be?
These rules aren't sensible. I think the first rule I would set that I think is easier to design is to say I'd have a rule around the flow of borrowing. And I'd probably say something like we will want to have a current budget surplus. We want to be on course to have a budget current surplus in, say, 3 years' time. That means that total receipts going into the exchequer will be bigger than day-to-day spending. That's similar in tone to the fiscal targets that both Gordon Brown and George Osborne had. So I'd imagine it could be pretty widely supported. And I think 3 years notice in the current environment gives you plenty of time to adjust to any small shocks that come along. So that's the target for borrowing, which I think would work pretty well. I think debt is harder. I think you do need something to limit the rise in debt. I think there are good reasons to want debt to fall over the medium term, because we know that when bad shocks come along, we'll want to elevate debt because we'll want the government to step in and help households and businesses and public services through those difficult times. So when we're forecasting in the medium term periods where we're not anticipating a particular bad shock, I think we should be aiming to get it down. I think what gets very weird is when you start to say, oh, it has to fall between 2 particular points in time, and it becomes incredibly sensitive to the the change in debt and the change in the size of the economy between those two moments in time. So I think maybe on debt, I'd have something rather looser that says I want the OBR to be saying that on a reasonable interpretation of my policy settings and my revealed behavior about policy, it seems reasonable to say that debt will be on a decisively falling path over the medium and longer term. And I think at least over the next 5 years, it's pretty clearly not on a decisively falling path.
Thank you very much. And I'm going to go down the list a bit and come to you again, Carl, while you're on. You said that the OBR is less pessimistic than the Bank of England. Do we have a view of which of the bank and the OBR has the better record of forecasts?
That's not something I've looked at. I mean, it's certainly true the OBR are more optimistic, and the OBR, for all the criticism it gets over the period since 2010, has tended to be too optimistic. It's been too optimistic about growth, and with it too optimistic about the extent to which revenues will come in. So we have to hope that they've learned the lessons from that period and that their current forecasts won't be prone to the same error. The disagreement between the two, as far as we can tell, and we don't get as much detail of the bank's forecast, so it's hard to know for sure, seems to in large part come about a different view about productivity growth over the next few years, the bank being more pessimistic about the outlook for productivity growth. And we know that forecasting productivity growth is particularly difficult. So perhaps it's not so surprising that's where there's a huge, that's where the difference is coming from, rather than say, forecasts about the number of people in the workforce or the average number of hours that they will be working. It's the unknown of what productivity growth is going to be over the next few years, which is driving it. I think it would be good if we got more details from the bank about their forecast and were more able to compare it to the OBRs, though. I think that would be great for people outside of those two bodies to be able to do that exercise.
Brilliant. There's a question here which maybe many of you are wondering: does any of this matter if a new Labour government comes to power next year? How much of what was announced will come to fruition and not be reversed? I think it does matter, really, for the even if that. I think it's going to matter for the election for the sorts of reasons that I described earlier, in the way that the conversation often takes place against what the baseline is. And of course, Labour, if they win the next election, will inherit a lower level of national insurance contributions, which they will have to make a decision about whether to keep, in which case they've got £10 billion less to spend than they would have done under a different baseline, and what to do with other elements of tax. So at one level, a lot of what we've described, and this is what we set out to describe in terms of the spending changes, are an arithmetic description of what the numbers announced yesterday would imply. They are not I think, most likely forecast of what will really happen, but I think they illustrate really quite clearly the challenges that will be faced by a new government, whoever that turns out to be. Would any of my colleagues like to add to that at all? No, that's fine. Again, going down the list, our labour productivity lags behind other G7 nations. How will investment in capital alone, with very little investment in human capital and reforms to national living wage and so on, kickstart a more productive economy? Well, look, kickstarting a more productive economy requires a lot of change. I think there were some aspects of what we saw yesterday which will help a bit. So the changes to corporation tax may help a little bit. There were some small changes announced to planning. I haven't read through the 110 other business support measures that the Chancellor claimed that he was putting in place, but the tone of the question is absolutely right. You need to have a long-term strategy which is focused on everything from capital infrastructure through human capital, particularly apprenticeships, vocational and further education, but also tax reform on a much bigger scale than we've had here, planning reform, and much more. Faisal Islam: is the total cut over the Parliament to non-protected budgets broadly the same as Osborne-era austerity, or a little bit higher, and the same for PSNI? Ben, I'm going to come to you on that one again.
Yes, I should say up front that I did these numbers during the set of presentations, so these aren't as finalized as some things might be. I think the reason I use broadly the same is that the definition of unprotected spending that featured in B's presentation is sort of unprotected in a sense that it doesn't include health, doesn't include defence, doesn't include childcare, doesn't include schools, and it doesn't include overseas aid. We don't have a consistent definition for that going right the way back, so it's hard to do precise like for like comparisons. What we can say is if you strip out health and you look at what's going to happen over the next parliament versus during the early 2010s, they do look pretty similar. On capital, again, if you look at net investment as a share of national income from peak to trough, the cut during the Osborne years, again, looks about the same size as the cut that's planned over the next couple of years under this government's plans. So I think broadly similar is right. I think that you could play with definitions, you could play with assumptions and get a number that's slightly bigger or slightly smaller, but I think we're in the same ballpark, and I think that's a helpful way to think about it.
Question from Erin Mansell. Women's Budget Group found that of household types, lone mothers will benefit least from the cut to national insurance, and their benefits are also more likely to be capped. Have we looked at any impacts of tax and benefit changes by sex? I think the specific answer to that is no, we haven't looked at that directly. Would that be correct, Sam?
Yeah, I think that is right. I guess all we could say that might speak to that is some of the differences we looked at by earnings levels and the mixed changes that we saw in that the choice to cut the rates rather than do changes in the thresholds, as we suggested, means that actually the decreases in or the changes, the cuts to taxes for people are going to be smaller for lower earners compared to higher earners. And if you think that lone parents might tend to be people on lower earnings, then that is something that could have an impact in terms of the choices that have been made.
I think that's broadly right. So if you look at the sort of longer term changes, clearly on average women earn less than men, and they're particularly likely to be low paid and in part-time work. So for example, the national living wage we know is much more beneficial to women, but on the other hand, holding the personal allowance for income tax frozen is going to have more of a negative impact on women on average, because they have lower pay on average. The national insurance cut, for the same reason as is described in the question, will be less of a benefit to many low-paid women than it is to people on average earnings and above. We are, I think, now, and I'm really sorry because we've got a lot of good questions. We really are at the end of our time. As I said at the beginning, this was a very big autumn statement. It leaves a lot of questions, I think, unanswered, and I don't think we're going to get those questions answered until after the next election in terms of what this is really going to mean for tax and spending. The Chancellor could have left himself with a very difficult budget in March, as Carl pointed out. There's time for the OBR forecast to get less good over that period. Nevertheless, there were some decisions in there. If you're going to cut income tax or national insurance, I think the decision to cut national insurance was a good one. If you're going to spend a bunch of money on corporate tax cuts, then, as Isaac pointed out, full expensing isn't ideal, but it's probably not a bad way of helping further down the road. But this really does, to repeat what I said at the beginning, this leaves more questions, I think, than answers, and a difficult set of decisions for whoever is a Chancellor in a year's time. So thank you enormously to my colleagues who have stayed up through the night to put all of this together. And thank you to everyone who has been watching. Please continue to support us, to look at what we're doing, to read our outputs. You can become a member and support the IFS if you want to look on our website how to do that. But if I don't see you all before, we will see you immediately after the March budget. Thank you very much.